Welcome to the Commercial Real Estate Show. I'm Michael Bull. This show is your source for market intelligence, forecasts, and success strategies. Well, today we're going to talk about commercial real estate finance. You know, debt is so important to the commercial real estate industry, and so that is our topic today. Please welcome my first guest, Lisa Pendergast. She is Executive Director with CRE Finance Council. She's joining us on the phone. Lisa, thanks for joining us.
You're welcome. Happy to be here.
Lisa, first of all, for the listeners who may not know, tell us briefly about CRE Finance Council.
Sure. The council really is focused on many aspects of the commercial real estate finance markets, be it CMBS lending, portfolio bank lending, insurance company lending, and really the idea is to help the CRE finance markets to remain as liquid and viable as possible, so that we can advance, the sort of state of the CRE markets, make sure that there's liquidity to borrowers and property owners. Ultimately, it's a great resource for driving, economic growth.
Thank you for that, Lisa. And we're glad you're doing that. Who are your typical members?
Our members include, as I mentioned, we have a lot of bank portfolio lenders and insurance company lenders. We have CMBS investors. We are starting to focus, too, on some of the alternative lenders that have sort of developed in the post-crisis environment. We have CMBS issuers who not only originate loans for CMBS securitization, but then sell and package those loans into structures that we sell then to pension funds and money managers and banks and life companies and the like.
Okay. And then you recently did a survey of your members, and I want to talk about some of the results of that survey today, but certainly they have a grasp of what's going on in the market and what to expect moving forward. And I think the elephant in the room for most people is interest rates, and what do your members expect interest rates to do in 2017?
I think most of our members watch the Fed very closely, and I think the Fed has been relatively good about benchmarking where they think rates are going to be at the end of this year. So interestingly, in our survey, our respondents pretty much were 80% of them believe that rates will rise somewhere between 25 and 100 basis points over the course of 2017. And that's not all that surprising, because I believe the Fed is on record to say that they are likely to move in 2017 by 325 basis point increments. Clearly, we're starting to see better signs of economic growth. I think what was interesting, while the first quarter GDP number wasn't all that overwhelming at 1.9%, what we saw were signs that business investment is truly starting to pick up, and that growth there, as well as an unemployment rate that everyone is very comfortable with at this point and has recovered nicely since the recession, all suggest that rates will rise. The key thing, I think, for our members is that while we are seeing a rate rise, and in that environment normally would be construed as somewhat of a negative, because as benchmark rates rise, capitalization rates rise as well. I think most assume that it's going to be tempered. This is not going to be moving in 50, 75 basis point increments. We haven't seen sufficient pickup in GDP, I think, to warrant that. And there are certainly other issues, not only here in the U.S. but abroad, that would suggest that the Fed is going to move cautiously as they raise rates. So generally, a modest increase coming off of very low rates is considered a reasonable thing to happen in 2017 that won't negatively impact CRE.
Right, and I like your point that you have to remember that rising rates is really good news, right, for the economy. That means the economy is moving forward, and our slow recovery may be picking up a little bit of pace. So 25 to 100 basis points in 2017. Any indication of beyond that what's expected?
I think that anyone who had a view as to where rates were going to go beyond 2017, say on November 1st, are now somewhat perplexed as to the developments that may occur this year. There are a variety of things coming out of D.C. That could spur economic growth. There are those things that could be very positive for commercial real estate, such as it relates to infrastructure. So if there are significant growth, or there is significant growth in infrastructure, that could be certainly a positive for commercial real estate that would benefit from that growth in infrastructure. To the extent that, there are also issues abroad, I think the concerns always are any pickup in volatility is not good for any kind of financial markets. It's not good for interest rates. It certainly wouldn't be a positive for the financial markets. So to the extent that there's a lot on the table right now from the Trump administration, we look forward to good things, but to the extent that it also causes volatility to increase, we know from experience that tends to put investors in all types of securities and real estate on the sidelines until things calm down.
Interesting. And I think of your members, I think of a smart group of people who are studying this and thinking about it and moving forward. So when you did your survey, or when you get a sense of talking to your members, how do they feel about a Trump presidency? Is it 80-20 that they like it, or 20% afraid of it, worried about what could happen?
Speaking to, that was not a question we asked directly, but I can say that I think that there are those that see some hope in potentially moderating some of the regulatory aspects that have caused markets to, particularly the CMBS market and the interest rate environment, to do things that were somewhat unexpected. So I believe that there are those who view some of the regulatory issues, let's say associated with Dodd-Frank, is associated with the risk retention issue, that need to be clarified and refined. And so to the extent that a Trump administration has ordered, for example, a review by the Treasury to look at Dodd-Frank and determine if there are things that could be done that moderate what is currently in place and perhaps rectify some of the excesses, if you will, while still keeping all of the principles of Dodd-Frank in force. So, for example, there are things that we would like in our marketplace. The Volcker rule, which was part of Dodd-Frank, was something that restricted proprietary trading. And our view, and I think our members' view, is that combined with things like Basel III and Basel IV, which really put a crimp on liquidity, have been negative events for investors in CRE debt. So, for example, in the CMBS market, the liquidity of being able to sell bonds in the secondary market has really come under significant pressure, and that affects all of our members. But, for example, a lot of our investors in CMBS bonds are life companies and pension funds, in government funds. So to the extent that those individual investors cannot get in and out of securities in a reasonable way without either not being able to trade or trade at excessive gaps because there's no one there to provide that liquidity, is something that we would like to see change. So, having the Volcker rule looked at, having some of the new provisions within the Basel III changes reviewed as to what impact they're having on the capital bases at certain banks that are really crimping the liquidity of these banks, are all things that we would have that I think our members would like to see looked at going forward.
Yeah, that's a good point. It did seem to crimp the style, especially with the small banks in the fourth quarter of some of the deals that we work on. So, I think it's interesting. And one thing you mentioned is interest rates rising, the impact on cap rates. And we're going to take a short break. When we get back, I'm going to ask Lisa Pendergast, with Executive Director of CRE Finance Council, what she and her members think about cap rates moving forward. And the rising rates, does that mean rising cap rates? What do they think? And also we're going to discuss where they think we are are in the cycle for the different property types. So stay with us and make sure you're connecting with us and commenting on the shows on YouTube, on iTunes. You're connecting with us on LinkedIn, Facebook, and Twitter. We love to hear from you. So stay with us. We'll be right back. I'm Michael Bull. This is the Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.